Welcome back. The Nigerian equities market continues to underperform after the January rally that saw the NSE All-Share Index post above 16% return. Several factors have been adduced for the sustained bearish state of the market, but investors remain worried as the gains of January are gradually being eroded with a current year-to-date return of 2.8%. On the other hand, activities in the fixed income market seems to be gaining momentum, with average yield on treasury bills and bonds progressively tending lower. What is the new big issue that will drive the equities market to the realm of positivity? Or are investors comfortable with the treasury bills and bonds given the inherent minimal risks? I'm now being joined by an investment analyst at AfriInvest Securities, Ayorinde Akinloye, to discuss some of these issues. Hello, thank you very much for joining us, Ayorinde.
Thank you.
Now, equity investors seem to be losing all hopes in the market with consistent drop in the equities. In fact, this last week, the market shared one of its biggest, weekly loss since the start of the year.
Yeah.
And one would ask, where lies the hope of the investor?
Okay, basically, we've seen in January, we saw the rally, which drove the All-Share Index gaining as high as about 17% in January. Since then, we've seen consistent declines over the past 4 months down to this month in May. The bearish sentiment seems to have been going stronger from month to month. In February, when we saw markets decline a little, we attributed it to some form of price correction in the markets following the rally we saw in December. But later, the price correction that we saw rebounded. We saw markets reverse that trend, and then we saw markets, for about 2 weeks or 3 weeks, did well positively. But then, since then, we've seen the bearish sentiment, become more stronger over the past few months. Particularly, we have seen a lot of major sell-offs in the banking sector, especially last week, where the banking sector lost almost 4% last week, and it was one of the major drags on performance for the market, for the equities market last week. So when we look at where investors can begin to look for hope for the market, we look at the fact that there are a lot of downside risks to the possibility of markets turning the trend, the bearish trend we have seen in the market. But in terms of looking at the possible positives that we can expect investors to look to, number one, we look at expected corporate performance from the companies listed on the stock exchange. So particularly for the banking sector, the industrial sector, and also we're expecting the oil and gas sector to do well on the back of improvements in oil prices. So looking at half-year results and full-year results, we expect that this will be one major source for investors' bullish sentiments and buying interest to receive a boost again. When we also look at the fact that in terms of valuation, our market is very much undervalued when we compare the Nigerian market with all other peers in emerging markets and frontier markets, and also the African peers. Because when we're looking at the market on the side of the price to earnings ratio, we are much more undervalued. As of Friday, we're at about 11.1 times. As a close of market on Friday, we're at 11.1 times. When we look at other markets, like for example, you take the Egyptian markets, for example, they're at about 35 times. When we look at Kenyan markets, they're about 13.6 times, and a host of other markets like that. So looking at that, we are still relatively undervalued, which gives room for potential upside. But investor sentiments now requires there needs to be news to drive investor sentiment to take advantage of the valuation.
What kind of news would we be watching out for that would drive that positive sentiment?
So we'll be looking at investors will be paying attention very much to activities in the developed markets, because what we are seeing generally in the Nigerian market is not just particular to the Nigerian market alone, it's particular to markets across emerging and frontier markets. For example, we look at the Ghanaian market that has been on a very strong rally all through the year. For the past 3 weeks, the market has shared gains. Last week, it shared its largest week-on-week losses. Last week lost about almost 3% last week too. So generally, we are seeing that affect the emerging markets generally, and that's a result of foreign investors pulling out funds and back to their own market, and that's because of expectations of the Fed to hike rates. So on the side of rates hike, activities in developed markets will be closely monitored by investors. Then also corporate performance from major companies in the banking space, the industrial space, the consumer goods, and the oil and gas space too would be very key to what will happen to investor sentiment in the long run.
And would you imagine light at the end of the tunnel in the near term?
Okay, in the near term, we're still looking at the possibility of this sell-offs to continue, because we look at the fact that most of the domestic investors tend to follow what foreign investors do. So we have seen foreign investors pull out of the market, and most of the time when foreign investors...
What is driving them?
Okay, basically we're looking at the lot of factors come together to have actually been responsible for them to decide to leave the market. Number one, when we look at the fact that most of these foreign investors, fund managers, and independent prop traders, we look at the fact that most of them have recorded a lot of gains. When we look at the rally in the market in June, July, we also look at the rally for November, December last year, and then we also look at the rally in January. So we see that most of these investors have actually gained a lot. If you bought into the markets, let's say GT Bank, for example, in June, July, you still be up at least like on 50, you still have some 30, 40, 50% gains on your portfolio. So most of these investors are looking at, okay, we are looking at the possibility of the election risk coming up. The political space is eating up now on a weekly basis. And when you also look at the fact that the developed market monetary authorities are looking at increasing rates, which could trickle down to their fixed income instruments, as we have seen U.S. Treasuries also increasing in yields on a weekly basis now for a while. So we are looking at these investors. So these investors are just looking at exiting the market, keep my money safe in Treasuries, where I know that I'm not going to lose anything. There's no fear of any loss of value. So I book my 30-40% gains, and then I keep in Treasuries for the rest of the year. By the end of the year, they would have met their targets, and it would have been defined as a fine year for them. So that's why we are seeing them move out of the market, and we are seeing domestic investors also following. So we might see some
But
sell-offs.
Shouldn't the reverse be the case?
Okay, yes, the reverse should be the case, because when you see the market, dipping, you see investors wanting to come in to,
domestic investors should be able to give the foreign investors the confidence to actually come into the market. Shouldn't it be so?
That should be the way the market should be. But we see the Nigerian market as a typical kind of market where the foreign investors determine most of the activities that go on in the market.